Hey everybody, welcome to this free edition of our Trader User Group. This is for the trading week ending D2nd, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is, I guess we kind of go back to the past when good news is bad news is good news. So let's take a look at where we are this past week and see what's changed or what seems to be changing as we go through the end of the year. So if we look at the performance in the U.S. markets, you can see everybody was in the green for the week with the NASDAQ up the strongest. Weakest was the Dow, but you can see year to date the Dow is the strongest right now. A lot of them were buoyed by the possibility the Feds are going to slow the pace of interest rate increases. A lot of it coming from the comments from the Fed Chair Boom Boom Powell. That would be Power Ranger Boom Boom Powell, kind of signaling that interest rate hikes are going to probably the aggressive nature of the rate of increase of interest rates are probably going to slow a little bit. But we're just going to see how all this stuff plays out. Now, this past Friday, the markets kind of retraced some of their move earlier in the week when jobs data came out a lot stronger than anticipated. But I will say, over the past couple of months, the S&P's moved up over 14%. It kind of puts it in a 98th percentile for 2 month performance, 2 months performance going back to 1936. So we've had a strong 2 months, but I'm going to show you a chart in a minute that just shows you that in bear markets, especially prolonged bear markets, we tend to have very strong moves higher, a lot of short squeeze going on, and there's still a big debate in the markets right now as to how all of this stuff is going to play out. Now, as I said, the jobs market was in focus this week. Boom Boom Powell was telling an audience at the Brookings institution that labor demand would likely need to soften as the central banks, are trying to bring inflation under control. And we did see economic data show the number of job openings declined down to, in the JOLTS report, down to 10.3 million. But non-farms payroll came in relatively hot. It came in at 263,000 jobs added in November. That was exceeding the consensus estimate, which expected 200,000. So the unemployment rate remained the same at about 3.7%. And we did see consumer spending increase to 80 basis points. So that is showing consumers are still holding up. Also, from an inflation perspective, we saw core personal consumption, which takes out food and energy. That's kind of one of the Fed's favored gauges that they follow, the core PCE. It increased 5% year over year. And the prior month was at 5.2%. So we are seeing it go in the right direction, right? And so that kind of gave the markets a little bit of a pause this week, but enough to kind of lift the markets for the week, as you can see on the charts right there. But as I said, the strong data, the Feds right now, the key information that I'm looking at coming up in the month of December is the December 13th and December 14th. The 13th is where we get CPI data for the entire month of November. I expect to see it come down just a little bit more. And then on the 14th, we get the Feds. Now, there's an 80% probability on December the 14th that we're going to get a 50 basis point rate hike. The current Fed fund futures is at 3.75 to 4%. So that would put it at 4.25 to 4.5%. Now, the expectation is for the Feds to end their rate hikes at about 5% in March, April timeframe of next year. So that means we still have rate hikes likely. Okay. So that's just something that we need to take into account. You can see on the right-hand side, upper right-hand side, the PE ratio is still a little bit higher than I'd like to see it. I think one of the big drawbacks for next year is we will see earnings per share continue to be revised lower, especially in the first half of next year. The earnings yield for the S&P is sitting at 5.61%. And the yield over the 10-year Treasury is still a positive 2.1, but the real yield is still negative. You can see it's right around 2% negative, which means inflation is still eating it away. So you've got money still taking on risk. Meanwhile, the VIX fell over 17% this week. We actually broke the 20 level. Now, just so that you guys know, every time we've come down to around this level in the VIX, it closed out the week at 18.95. Every time we've come down there, we get a pop in the VIX. Now, I'm not expecting, short of what we get on the 13th and 14th of December, which are two key milestone dates in the month of December. If they come in at market expectation, I see a continued rally through the end of the year, but then in Q1, possibly the beginning of Q2, I see a dip back down again, or a pretty good little sizable dip. It depends on where the earnings come in for Q4, because they're going to kick off in the middle of January. All right, so that's something that we got to really account for. Meanwhile, if we go across the pond, let's just put this out here like this and see what's happening there. You can see over in Europe, with the exception of Germany, the German DAX, most of Europe was in the green this week, but just barely. Um, we did see shares in Europe, they're up 7 weeks in a row right now. The euro's up stronger, and as I'll show you in the charts in a minute, I've got our members into the euro many weeks ago, which I think is still going to be a good move. Inflation in the eurozone did come down a little bit in November for the first time in 17 months. So that improves sentiment just a little bit. Okay. A lot of that is primarily due to smaller increases in energy and services costs. Okay. So we're seeing some of that. Inflation, I think, came in at like 10% from the prior month's 10.6%. So we're still very high with inflation. The ECB over there is still looking at raising rates, but they're not as aggressive as the U.S. Feds are here. Okay, and of course, if we go further to the Asian markets and we look at the Nikkei, China, and Hang Seng, you can see the Nikkei was in the red, China was in the green, Hang Seng was in the green. But you can see there year to date, with the exception of the FTSE, everybody's in the red, including the U.S. markets, right? Over in Japan, we're seeing industrial production. It fell a pretty good little bit in the month of October. It fell 2.6%. And the prime minister there, one thing they're going to do, government's always spending over in Japan. They're going to increase their defense budget by 2% of their GDP. They're going to do it slowly over the next 2 or 3 years, but that represents government spending, just like the stimulus that they're putting in there. Meanwhile, in the Chinese markets, as I said, they finished in the green this week. Year to date, they're still in the red. But China is having major issues. First of all, they've got a lot of civil unrest and a lot of riots going on over there. And it's forcing China. It looks like they're going to edge away from some of their really crazy zero tolerance approach to COVID. So they're going to lighten that up a little bit, but I don't think it's going to be enough. I think the riots are going to continue, and that's going to hurt their economy on the economic front. The other thing is, in the economic news, their official PMI readings for manufacturing and non-manufacturing both weakened in the month of November. All right, they're coming in at 49.4. So anything under 50 shows contraction, and that's what we're seeing in China. So these could be early warning signals that I do believe next year earnings estimates are still too high. PE ratio is still too high for the U.S. markets. I think it's going to have to come down a little bit, which suggests we're going to fall a little bit deeper than most market participants are expecting for Q1 and Q2. Once we get through that, and then we find a new lower low, which is what I think we're going to see, then I think the market's going to be ready for a nice little robust rally that's going to be a little bit more extended. What I'm going to do is I'm going to shift the screen here. So let me just, I got to just move a few things around on my screen here. Let's do this. I'll take you over to the charts. Right here, it'll take a couple of seconds, 10 seconds or so to come up on the screen for you guys. And what we're going to look at first is the E-mini S&P 500 futures, which is where most of the action happens in the U.S. You can see that big rally off my targeted low zone. We hit that back in on 10/13 of this year, so in October, and then we've just had a good rally since. Pretty strong rally. I do believe these lows will be taken out, and we could possibly go down to 3,300 in Q1, Q2 of next year. I think the Fed is going to be forced to take on a little bit more aggressive action and hike the rates just a little bit higher to really get this inflation subdued. But you could see here that yellow line's the 200 EMA, and you could see where we finally crossed the 200 EMA on the 30th of November, the last day of the month of November. And then in December, we kind of peeled back just a little bit, but it almost has the lookings of almost like a bull flat, right? Which tends to be a a bullish signal on the charts. I mean, if I were to just say, there's the flagpole right there, and then you got that kind of movement right there like that, I just check those out. Typical movement is up in that direction, and it's generally the length of the flag, which is about like that, which puts us right up here. I don't see us getting much more higher than the 23.6 fib node, around 4175 to 4200. Okay, that's kind of where I see it. Now, I'm going to switch the screen just a little bit and give you a little bit bigger, broader perspective, looking at a weekly chart. And if we look at this weekly chart here like this, and this is the SPX, the cash index, you can see we had a big rally here back in February, March timeframe, April timeframe, and the rally was a little over 12.5%, representing 546 points. And then we started to form this downsloping trend line. We came down and we made new lows, and we had another rally. This time it was 600, almost 690 points, about 19%. Very strong rally. Okay. And then we hit the downsloping trend line. This red line is the 200 EMA or SMA. And you could see where we're sitting here on this. Now notice the SPX cash index is slightly under the 200, where the futures is over. But then we had that rally, we've come back down. Now, where are we on this current rally here? We're at about almost 16.9, call it 17%, 592 points. So this was 516 points, this was 690 points, and we're at 592 right now. So that shows we can have strong rallies and still roll back over. We're inside this symmetrical triangle right here. If we can climb back up over this 4133, remember 4126 is where that fib node sits, and that was my targeted low near term for this year. I don't think we'll make a new low this year, but I do believe going out in time in Q1 or Q2, the odds favor making new lows, taking these lows out, and that should be it for this down move. So I just wanted to show you that we can have these very strong rallies in this overall bear market and then roll back over. All right. Now, if we come back in here and take a look at the charts again, and I'm going to show you the NASDAQ. NASDAQ is the ugliest performer. It's down over almost 27% year to date as we go into the last 3 or 4 weeks of trading. You can see NASDAQ is sandwiched between the 50 and the 200 EMAs, well below the 200, okay? And it's having difficulty getting leverage here. So the movement in the markets that is forcing the up move is not as much on growth stocks as it is on industrial, energy, and value-oriented dividend-type stocks. So we are seeing that strong rotation, which has been continuing for the past 90 days, as I've talk to our members about and ways to play it and things like that. So this is kind of what I'm seeing right now in the markets. And of course, if we come over here and look at volatility, if we look at the VIX, you can see we've finally broken this level right here very solidly. We tested it a couple of times and we've come down below. And if you look at it, the last time we were down here, we were here for about a week, right around this level, right? Back in August, in that big August run. And then when August rolled over, away we went. But if I just take it out to 1 year, right, and let's just make this chart equal to 1 year, you can see going into the beginning of January when we had our all-time highs in the S&P, outside of the through the second week of January, we haven't seen this anymore. Very occasionally, we had come down in this area here at the end of March, early April, and we actually hit a couple of lows down here. But we never did go below 18. We were always 18 and higher. Same thing right here. In this case, we were 19 and higher. Here, we're a little over 19. So let's see where this thing goes. But traditionally, what we've seen every time the VIX gets this low, we have a rally in the VIX and volatility, and the equity markets roll back over. So we're at those levels that this can happen again. And it would not surprise me to see it. If we look at the bond market, the bonds continue to rise, interest rates continue to fall. The bonds are now in a higher movement to the upside. Now remember, this is a 30-year bond. which tends to show that the economy over time is starting to weaken, or at least the bond market is betting the markets are going to weaken out in the future, and it's going to force the Feds to pivot, not pause, but pivot. Right now, they're still increasing their rates, and then they talked about pausing for 2 or 3 Fed meeting cycles to see how the market economy fares before they go back in and do something with the rates again. But the 30-year bond market is saying they're going to be forced to pivot and start cutting rates towards the end of 2023. That could not be good news because that would suggest 2023 is not going to be a good year. Keep in mind that 2022 for many people have not been a good year, right? For those following what we're doing in our user group, we've done very well. We're making good money this year. But if you're just basically holding stock or municipals or treasuries, you've lost money this year, right? So that would be the bond market. And then if we look at the 10-year interest rate, you're going to see it coming down as the bonds go higher. You can see we hit my target. We moved up slightly above my target, and now we've broken the 50 EMA, and we're right at a support zone right here. Now, this level right here would suggest to me that it's probably going to get choppy, possibly move up. I've got a longer term target of the 10-year way up here over 4.5 to 4.8%. That would suggest that the Feds are going to be more aggressive than what the markets expect in hiking rates. They haven't telegraphed that yet, and the markets don't expect that. But if they do, you're going to see this take off. Okay, it's just gonna it's gonna really be ugly for price action in the S&P. Okay, I don't see a lot of this strong activity happening in the second half of next year. I see the first half is where all of our risk is going to be. Through Q1, early Q2 of next year is where we have the risk of a bigger down move. Once we get through that period, we should consolidate, and we'll get enough market data to determine, are we going to have a soft landing, a hard landing, or no landing at all, no recession at all, right? So we're going to watch this very closely. If we look at currencies, you can see the US dollar had a really down day on Friday. It broke the 200. Up at this level here, you can see that I was talking about going long the euro rather than shorting the dollar. Just go long the euro. It's an easier trade to make, especially in the euro futures market. So we were in this trade for a while, especially breaking the 50 EMA. Now that it's broken there, I think it could go even further. And if we look at the euro right here, it's the mirror image opposite of the dollar. We actually broke the 200. Now, we did a retest of the 200. I could see another retest of the 200, but the euro is forecast to run up even more, another 3 or 4 pennies on the dollar, right, to 108, 109, possibly even up in this area up here. So we've got our trades on, or at least I've recommended trades to our members that a lot of them are making some really good money in this trade. It's a low-hanging fruit trade. I mean, it was one that we just watched for about 4 or 5 months. You can see here, this is the 50 EMA. Every time we got up to it, we broke down. Every time. The minute we finally broke above the 50 EMA, I said, look for a retest. We got a retest. It broke below. Soon as it broke below, I said, if it takes out the prior pivot high over the 50 EMA, go long the euro. And sure enough, it did that on 11:10, and that was the trade, right? And boom, away you went. I even suggested to some of our members that wanted to front run, you could jump in down at these levels down here, because I think longer term, it's not going to make new 2022 lows. If anything, it's going to take off to the upside. Remember, the euro got down. We haven't seen it this low in quite some time. It was down to 95.9 cents on the dollar, right? Very low. And then, of course, if we come down here, and we look at gold, gold has finally cleared a key level, all right? You can see how gold has moved up. We cleared the 200 EMA. It probably is going to come back and test this level again. We're still in the red for gold futures this year, but I think it's going to make it back up. We've had these big, huge, look at these big days here. And the reason why gold is moving up this strong is because the dollar is doing equally obnoxious down moves. A weaker dollar, stronger bond market helps gold, and that's exactly what we're getting. Gold and silver are doing very well. And if we look at silver right here, you can see the silver market is now finally just sitting right at break even for the year. You can see what it did with the 200 EMA. It did the natural break, retest, came up to a resistance zone here, didn't even look back. I could see a retest here, but then I think it's going to move up, right? And if we just look at a potential Elliott wave count, I think silver is going to move way back up into this level, back up in this area here again, around $25, $26 an ounce for silver. So all in all, it looks very good for silver and gold, all precious metals, right? Now, if we look at copper, let's see, let me find copper on here we go. Copper is an interesting trade. You can see here with copper, where it broached the 50, it came up, could not hold the 200, came right back down, did a retest. That would be an active buy signal on copper, and it's sitting right under here, right? I would take the profits and wait for a break, take out that prior pivot over the 200. If it takes that out, then it would be a long copper play. A lot of it's going to depend on where China's going. And if you recall, I said China had PMI data that shows contraction in that economy. If we do get that pullback that the markets seem to be suggesting, or the charts seem to be suggesting right now in Q1 going into Q2, there'll be plenty of opportunity to pick up some of these commodities at a better price. So I'm kind of standing down on some of these right now. And then, of course, if we look at energy, and if we look at oil, let me just find that on here. Here we go, right here. If we look at oil futures, um, uh, we've got a way to trade oil futures to me that makes sense. I think the odds favor oil not to get up too high and to roll back over again. Remember, oil goes down in signs of a potential or an impending recession or a global recession. Should we get that down move in Q1, Q2, I think oil is going to move lower and it'll be a great long buy. I do know that Goldman and Morgan and some of the other oil trading desks are saying oil is going to be over $100 a barrel in the summer of next year, but I don't see it just yet on the charts. We've got the 50 below the 200, so that gives me a bear chart, not a bullish chart, which means most rallies are sold off. And until I've proven otherwise, that's the way we got to treat it. Nat gas, well, we've had our trades in nat gas. Um, I wanted to see this get elevated even higher. It looks like it may not do it. Up at this level up here, we were shorting nat gas. Over at this level here, we were shorting nat gas. Here, it's kind of in no man's land. A lot of it's dependent on the weather. Part of the reason why nat gas is coming down, even though Europe really needs nat gas, they've got strong storage there. It's looking like that they've got a lot of ample storage supply, more so than they've had in decades. So that'll help them. And word is coming out that the winter months may not be as ferocious as earlier expected. So that tends to put a little bit of a downward pressure on nat gas, right? Nat gas is really driven a lot by the weather patterns. However, this year, because of Russia and Ukraine, it's been elevated, but it's given us great shorting opportunities. I think nat gas is going to come back down towards this level down here below 4. It's just going to take a little bit of time to get there. All right, everybody, that's kind of what I'm seeing right now on these charts. Members, I will see you tomorrow evening for our weekly market watch. If you're not a member, I highly encourage you to come in. This year has been a gangbuster year for us, and I think next year is going to be the same. We're going to have some really good opportunities with stretched markets, stretched commodity markets, and a few key stretched equity markets here for plays. All right, everybody, have a great weekend. Go USA Soccer. Otherwise, I will catch members tomorrow evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao.